Oil touched $100 on January 2nd, 2008 and then kept rising aggressively. By July, it had peaked at $150 per barrel, the highest level in the modern economy. Prices peaked around $114 per barrel and then stayed above $100 for almost 2.5 years. At the same time, it would be sensible to avoid sectors that are highly sensitive to crude prices, such as paints and oil marketing companies like HPCL and BPCL. Hi everyone, welcome back to the Smart Alpha Show. I'm Yogesh, partner at Magnus Hathaway Investments. Markets were very brutal in the last few days. So in today's video, we're going to discuss something very important for investors. What has historically happened during periods of high crude oil prices? And more importantly, how can you position and protect your portfolio during times like this? Crude oil has once again crossed the $100 mark. Whenever this happens, markets immediately starts worrying, because historically, oil staying above $100 has rarely been comfortable for the global economy. Let's look at the past three major episodes when oil crossed $100. The first was the 2008 commodity supercycle. Oil touched $100 on January 2nd, 2008 and then kept rising aggressively. By July, it had peaked at $150 per barrel, the highest level in the modern economy. But this rally did not last forever. As the global financial crisis intensified and Lehman Brothers collapsed, demand expectations fell sharply. Oil finally dropped back below $100 on September. In total, oil stayed above $100 for roughly 255 days. The second episode came during Arab Spring in 2011. Political instability across the Middle East and North Africa disrupted supply, especially from Libya. Oil crossed $100 again on March 1st of 2011 and remained elevated for a surprisingly long time. Prices peaked around $114 per barrel and then stayed above $100 for almost 2.5 years. The cycle eventually broke in late 2013 when the US shale boom dramatically increased global oil supply. However, the most relevant example for us today is the Russia-Ukraine war in 2022. When Russia invaded Ukraine in Feb, oil crossed $100 in early March and surged close to $120 by mid-June. Our global supply chain adjusted quickly and demand fears returned. By early July, oil had already fallen back below $100, meaning the spike lasted roughly 125 days. This tells us something very important. Most geopolitical oil spikes are temporary supply disruptions. Markets initially react with panic, but supply adjustments usually follow. Which means the current situation could also be a short-term disruption. If supply flows normalize, the pressure on oil prices may not last for more than 1 or 2 months. Now, the key question for investor becomes, which sectors in India remain relatively insulated from the rising crude oil prices? There are three sectors that historically show much lower sensitivity to crude oil prices. The first is banking and financial services. Banks have very limited direct exposure to crude oil. Today, some banks in the sector are trading near a 15-year valuation low, with price to book around 2.2 times and Nifty Bank P close to 17 times. And at the same time, credit growth in India continues to remain very healthy, driven by retail loans and infrastructure lending. If RBI enters a rate cut cycle later this year, it could further support loan demand and bank margins. The second sector is pharmaceuticals. India already supplies more than 40% of generic drugs consumed in the United States. And at the same time, geopolitical tensions and tariff differences are giving Indian manufacturers an advantage over Chinese competitors. Trade agreements with the US and Europe could further expand the export opportunities for Indian suppliers. The third sector is telecom. This is largely a domestic pricing story and is not directly linked to crude prices. Average revenue per user continues to rise, with Airtel ARPU already around 256 rupees, while Jio continues to increase prices gradually. Analysts expect another 15 to 20% tariff rise in the coming year, and the ongoing 5G migration is pushing subscribers toward higher price plans. This creates a steady earnings growth cycle for telecom companies such as Bharti Airtel. So if I were to deploy fresh money today, I would prefer positioning in sectors that are relatively insulated from the crude oil volatility. Because the reality is, we simply do not know how long these geopolitical tensions will last. Each of these sectors also has strong individual tailwinds supporting their earnings growth. At the same time, it would be sensible to avoid sectors that are highly sensitive to crude prices, such as paints and oil marketing companies like HPCL and BPCL, where rising crude prices can directly pressure margins. We do analysis like this day in and day out at Magnus Hathaway Investments, constantly studying about global developments and how they impact markets and portfolios. If you found this video helpful, it would be great if you could subscribe to the channel and share this video with somebody who could benefit from it. And in the last, thank you for paying attention to this matter.